So as we all know, the expected cash flow is the cash flow an investor or a company expect to realize from a project before that project begins. And however, the actual cash flows received may be greater or less than the expected future cash flows. In income approach, the expected cash flows is the most critical aspect in the application of it since predicting the future values is open to a certain degree of uncertainty, and such uncertainty is linked to various factors. So, various factors includes first the characteristic and stability of industry. So, if an industry is stable, estimates are more reliable, and if the industry is characterized by greater volatility, accurate estimates are difficult to make. So, the volatility refers to the fluctuation of the price of a security or an interest rates. And however, there are industries that tend to be stable but may be exposed to short-term volatility like the real estate that has resumed its historical growth trends after having a slowdown due to like the subprime crisis. And next factor is the management's ability to predict how the business will evolve. So the management must have the necessary skills to foresee potential developments, as forecasting future results can be extremely complex in all businesses. And as what I have mentioned earlier na, there are some industries na stable but may be exposed to volatility. So with that, the cash flow is expected to be less predictable and an accurate calculation of the expected cash flow starts from historical results and requires identifying the development strategies that are consistent with characteristics of the firm and the industry. The management shall also formalize a business plan, and the valuers will verify that the assumptions underlying the business plan are consistent and correct to make sure that cash flows are reliable. And another factor is comparability between future and past results. It is a greatest risk to forecast future cash flows that are significantly out of line with past cash flows, and that is why the expected cash flow must be compared with the previous cash flow. The valuers must also verify the validity of the assumptions in the business plan and examines the reasons for potential improvement. And also, the analysis of the past results can help valuers to understand the relation between past performance and future performance. So the asset side and equity side of valuation. So since um, we are discussing about the income approach, we must know on how to compute for the value of the firm. But before that, the free cash flow in the asset side and free cash flow to equity on the equity side must be computed first since it is part in the formula for computing the value of the firm. So as you can see, on the left side is the formula for computing free cash flow, and on the right side is the free cash flow to equity. The free cash flow to equity is the remuneration received by the shareholders at the end of the year through part of the cash flows, while the free cash flow measures the remuneration of companies' investment, which are financed in part by equity and in part by debt. So if these are already computed, the computation for the value of firm will be followed. So as you can see in the formula, variables combine differently within the two since in the equity side valuation, the value of the firm is calculated through the free cash flow to equity discounted by the capital asset pricing model, which will be discussed later. And in the asset side valuation, the value of the firm is calculated through the free cash flow discounted by the weighted average cost of capital to be discussed also by my group mates. So for the time horizon, the value of the firm is linked to the expected cash flow that a firm can produce over an appropriate time horizon, which means that the forecast must be consistent with the management's ability to predict the business evolution in a sufficiently reliable manner. And the time horizon may be different depending on the industry and as what I have mentioned earlier na There are industries that are stable and some are volatile. So if industry is stable, they can estimate its cash flow over a period of several years, and if it's a volatile, it can estimate cash flow over a limited time only. And cash flows relating to different periods must be discounted through a rate called the discounted rate, which will be discussed by Jean. So the formula, uh, previous slide, Mon. So the formula for the present value is expected cash flow over the 1 plus discount rate, which is the discount rate to the power of t, the year. So in the example given in the PDF, assume that the cash flow for the year is $100 and the discount rate is 5%. The present value of the year is calculated by $100 divided by 1 plus the discount rate, which is the 5%, equals to $95.24. And if the cash flow for the year for the second year, the discount rate is still 5%, present value is $90.70. And
Okay,
next,
Micah. So the present value formula that you have presented here, so that's expected cash flow over 1 plus I being your discount rate, right?
yes,
So
yes.
the discount rate will change, or what discount rate should be used will depend on whether we are using the asset side or the equity side valuation, right? So the I there will then be replaced by the specific discount rate that we are going to use. So if si asset side atong gamiton, unsa atong gamiton nga discount rate again?
Ang ang sa asset side,
What discount rate should we use? So, di ba kay 1 plus I man na I being the discount rate. So, ang I there is general, like the general discount rate. But if we are to apply it specifically, let's say asset side valuation or equity side valuation, the katong I, nga discount rate will be replaced with a specific discount rate. So, for asset side, the
it is
discount rate will be
the weighted average cost of capital is
correct. Then for equity side,
the capital asset pricing model.
okay, so from our general formula nga katong present value is equal to cash flows over the 1 plus I. So ang I
Yes,
dira is i-change nimo depende sa imong
depende sa,
valuation.
yes, yes.
Okay.
Okay,
Thank you.
thank
Sige,
you.
proceed.
So the next slide. So for the risk, risk is a variable is to consider when estimating cash flows. And according to the theory of finance, there are two reasons why risk cannot be ignored when evaluating investment based on expected results. First is the expected cash flow are inherently uncertain as they depend on the events that can only partially be controlled by the company, like the characteristics and stability of the industry as mentioned earlier. And second one is risk is not the same for investment. Two firms in different sectors and with different risk profile are not worth the same, like kanang mga real estate na stable ra so gamay rang ilang risk and ang like for example the technology related sector naman wherein estimates are difficult to make kay changes may take place that suddenly alter development prospects. And next slide.
Now we move on to the discount rate. Discount rate is the rate of return used to discount future cash flows when calculating an investment's present value. So it only makes sense for a company to proceed with a new project if its expected revenues are larger than its expected costs. In other words, it needs to be profitable. The discount rate makes it possible to estimate how much the project's future cash flows would be worth in the present, and a company's discount rate is used in calculating the net present value of an investment. The net present value is what the value of future cash flows is worth today. So if an investment's net present value is a positive number, then it is considered a wise investment since the returns were greater than the investors or company's required rate of return, or another name of discount rate. Second slide, please. The discount rate adjusts the expected cash flow according to: first is the monetary value of time. A discount rate is applied to future cash flows because money earned in the future is less valuable than money earned today. This is actually based on the principle that money should make more money over time, and a concept known as the time value of money. In other words, money not spent today can be expected to lose value over time. Thus, the present value shows that the money received in the future is not worth as much as an equal amount received today. Now, second is the risk of firm, industry, or country. When you say risk, it is actually the possibility that an actual outcome may differ from the expected outcome. Now, when you take a risk, you will be able to earn a reasonable return. Now, what should be your return when you take more risk? If the risk is more, then should the return also be more? Well, obviously, yes, because you would want to earn more return for taking more risk. In other words, the project that would carry a high risk should give a high return. So when you evaluate a certain project, you need to find its present value of cash flows, and finding the PV will need the discount rate. In other words, the discount rate aligns the cash flows pertaining to different periods and takes into account their volatility based on the firm's riskiness. Next slide, please. Now let's move on to the cost of equity. Next slide. When you say cost of equity, it's actually the return a company requires to decide if an investment meets capital return requirements. It represents the compensation the market demands in exchange for owning the asset and bearing the risk of ownership. Now, one way to calculate the cost of equity is by using the CAPM, or the capital asset pricing model, in which we will use the formula shown on the screen. The cost of equity is equals to the risk-free rate of return, that is your government bonds rate, or the rate of return paid on the risk-free investments such as the treasuries, plus the beta, which is a change of price due to change in the index and basically the sensitivity of the stock to the market. Now, what do you mean by sensitivity of the stock? It means how risky it is. Now, that beta should be multiplied to the equity risk premium, which is the differential of market return and the risk-free rate, to get the cost of equity. Now, if the beta increases, what do you think will happen? If we were to increase the beta, the cost of equity also increases. And why is that? As what I've said earlier, if the risk increases, people are investing in the company or holds a share of stock will surely demand a greater return given that they have a higher risk, which means more risk means investors are going to want a greater reward. And so as the beta goes up or gets higher and higher, the cost of equity increases as well. Next slide. Now, the minimum return required by shareholders for investing in a firm is equal to the yield of government bonds. The risk-free rate is also the rate of return that investors require for investments with no risk. In essence, this return compensates investors for the time value of money. which means that inflation dictates that the money in the future will not purchase as much as it does now, and the risk-free rate compensates investor for their time that their capital is tied up. Now, in identifying the most appropriate risk-free rate, valuers must consider two aspects: the time horizon and the geographic relevance. Next slide, please. When we say risk-free rate, it is actually the certainty that an actual outcome will not differ from the expected outcome, which is very different from what I've discussed on what risk is earlier, because basically risk is the actual outcome is different from the expected outcome. So if you are going to invest in a risk-free investment, why are you getting back a return? Well, the pure time value money is measured by the risk-free rate, which is the reward for merely waiting for your money without taking any risk, as you know, with certainty that you will get your money back. So when we say the time horizon, it is the period where investments are held until they are needed, or it is the period of time one expects to hold an investment until they need the money back. So the longer the time horizon, the riskier a portfolio will be. Next slide, please. The second aspect to be taken into consideration is the geographic relevance. Each country has a specific rating and a different risk-free rate. Hence, it is undisputed that a German company, for example, should be assessed using the German bonds as the risk-free rate. However, what will happen if a company is headquartered in Germany, which is a triple A rating, but exports 100% of its product to a B rated country? What do you think will happen? Does the risk-free rate continue to be that of the Germany, or does it become that of the country to which it exports? Well, the answer is actually it is up to the valuer's judgment to make the choice that best reflects operating conditions. Next slide.
Now to add to what Jean has mentioned, no, with regard to risk-free rate, so from the name itself, risk-free, so it's free from risk, and this is based mostly on government bonds. Now, government bonds are those debt securities that are issued by the government, and nganong kaniman ang ato ang basis sa risk-free rate, meaning wala jay risk at all, because we can expect the government to really pay their debts. There is no risk that the government will default on their obligations. So if naiutang si government, it is presumed that the government can really pay whatever they are promising to pay you. So that is why government bonds are the basis for the risk-free rate. Okay? Sige, continue.
So now proceed. The second component of the CAPM formula is the beta or the beta. So it measures the specific risk of an investment. Moreover, it consists of two elements, the systematic and the unsystematic risk. So the systematic risk is the part of risk linked to the general market trend. The same industry, systematic risk is the same for all firms. On the other hand, unsystematic risk is the part of risk unrelated to market trends, but it is linked to the firm's specific characteristics such as operational efficiency, profitability, and ability to make effective investments. So, uh, shown here is the betas formula, or what we can say as the historic deviations of the security with respect to market performance. So, this is beta sub Li is equal to COV Ri Rm over sigma 2 Rm, where the It is the levered beta of security, and RI is the return on security, RM is the return on market, and COV is the covariance between securities return and the market return, and the O2 is the variance of the market return. So furthermore, beta can take these following values. So when it is the beta is less than zero, so the security moves opposite to the market. In this case, for example, for inverse exchange traded funds, however, these are isolated cases that do not concern the beta firms. So when the beta is equal to zero, it is the security movement is uncorrelated to the market. This is the case for the fixed yield of assets. However, a bet of zero does not mean the investment is not risky. It simply means that it has no correlation with the market. For example, let's say walking over a rope between two skyscrapers is certainly risky, but in economic terms, the beta is zero as this activity has no correlation with market movements. So next, when the beta is in between 0 and 1, the security moves in the same direction of the market, but with less volatility and therefore with low risk. In other words, the investment is affected by market performance to a less than proportional degree. And the next, when the beta is equal to 1, the security moves in the same direction as the market with the same volatility and therefore with the same risk. And lastly, when the beta is greater than 1, uh, the security moves in the same direction as the market but with higher volatility and therefore with high risk. In other words, the investment is affected by market performance to a more than proportional degree. Next is the levered and unlevered beta. In both cases, the levered beta is an aggregate figure based on the beta of listed companies. The levered beta reflects total risk, which includes both operating risk and financial risk. Operating risk is specific to the sector. Conversely, financial risk reflects the average financial structure of the sector that is required to sustain a certain level of investments. Valuers must first cleanse the levered beta from financial risk and then calculate the unlevered beta. In other words, unlevered beta is a measure of operating risk alone, irrespective of the financial structure of the aggregate data, which could be different from that of the target company. The formula is as follows. So this is B sub U is equal to B sub L over 1 plus 1 minus T times D over E, where B sub L is the levered beta, T is the tax rate, and D over E is the last fiscal year sector's average debt to equity ratio.
Okay, Mon, can you repeat BL for levered beta? This is based on what? This is the levered beta of
Uh, Levered beta is, pardon, miss?
what is this levered beta? Is this the levered beta of the company or of the market or of the
Yes, miss.
sector
Levered beta is the beta of listed companies.
of the listed company? So it's not specific to one company alone, right?
Yes, yes,
So it's like we can say this is the sector's levered beta.
yes, miss.
So how is it different with the levered beta that is um, part of your what you call this previous nga formula? So can you go back to the previous slide? Kana. So how is it different with this levered beta as to that other levered beta that is included in the next formula? So if you can see, the levered beta here has a sub like I, right? So
Yes.
levered beta, this is the specific levered beta of that certain company. So if you are to look at the levered beta of a specific company or a specific investment, then this is the levered beta kaning nga formula inyong
Mila.
gitanaw,
Yes,
right?
miss.
And then but if you are what you have, if the information that you have on levered beta is for the entire sector or for the market or for the entire country, so not specific to a certain company, so that is the levered beta that you can see on the numerator. So
Yes,
if
miss.
you are to compute the levered beta of a specific company. So but you what you have is the levered beta of the market. So first thing you need to do is to convert the levered beta of the market to the unlevered beta, and then from the unlevered beta then you convert it to the levered beta of a specific company. So balik magsugod ta sa levered beta sa market baron or sector, and then convert it into unlevered, and then ibalik na pud nimo siya og convert into levered, but this time the levered will be specific na to that to that certain company that you are trying to look at. Okay? So
Then,
tanawa lang ang difference. Thank you. Okay.
Kim's,
Sige, proceed.
uh, for example, assuming sector beta is 1.24, tax rate is 22%, and industry average debt to equity ratio is 0.65, the unlevered beta can be calculated as follows. So as you can see in uh, the equation equals to 0.82. Just substitute all the values to the formula of the unlevered beta. So this means that if the sector beta is equal to 1.24, the operating risk is equal to 0.82. So next is the multi-company business beta. So the discussed portion of the beta a while ago applies to companies that operate on a single business. But what if a particular company is engaged in more than one business? In this situation, the beta of each business must be calculated and weighed according to a representative variable. So table 4.5 shows the unlevered beta of a peer group, the debt to equity ratio, and the revenues of the individual BUs, or the unlevered betas. So assuming a tax rate of 22%, the levered beta of each unlevered beta is calculated using the formula previously examined. So and this is what you see on table 4.6, the business units unlevered betas. And then finally, the weighted average levered beta of the firm can be calculated on the basis of revenues realized by each unit. So next is the main weaknesses of beta. So the first one is it is considered as the only benchmark for calculating risk. So in theory, the arbitrage pricing theory, or the APT, could be used as an alternative, unlike the CAPM, which assumes that the risk is summarized by the market only. The APT admits multiple sources of risk, consisting in unexpected changes in the fundamental macroeconomic variables, or which we call as factors. And these measures the sensitivity of the investment to each of these changes with a specific beta. In short, the APT assumes that investors take advantage of every arbitrage opportunity. If two assets, or like we say two portfolios, have the same exposure to risk but different expected returns, investors will buy the asset with the higher expected returns, thereby increasing its price and also thus lowering the expected returns and restoring balance. Subject to the difficulty of identifying the factors and estimating the sensitivity and the risk premium for each of them, the APT, unlike the CAPM, measures market risk with respect to multiple macroeconomic variables. In any case, valuers must be aware that if they replace the CAPM with the APT or with other models, the objectivity and demonstrability of the valuation may decrease as a result. Since the CAPM is widely used in the financial markets and is a reference standard due to the ease of calculation and wide information base. So according to the APT, the cost of equity is calculated as follows. K sub E is equal to R plus beta 1 times RP1 plus B2 times RP2, and so on and so forth. Where R is the risk-free rate, the sensitivity of the asset to the particular factor, and the RP is the risk premium associated with a particular factor. So number two, for small businesses, second weakness of beta For small businesses, it may not be a representative for it assumes a risk return similar to a large company. So both the valuation practice and some textbooks suggest that making adjustments to the beta to take account of greater riskiness of a small company. If this choice is not supported by adequate sources, there is a risk that the CAPM will reflect the valuer's sensitivity rather than being based on objective elements. It is preferable not to make any adjustments rather than assuming percentage increases or decreases based on subjective assumptions. In practice, there is no entirely rational criterion for adjusting the beta according to the size of the firm. Next, so the third component of the CAPM formula is the equity risk premium or the ERP. So it measures the expected return required by investors on top of the risk-free rate in order to offset the risk of an investment. So ERP has two risks. So they are specific risk and generic risk. Specific risk is that of industry unlevered beta and of the firm levered beta. It is related to the characteristics of the specific business and reflects a wide range of variables. On the other hand, generic risk is linked to the country in which the company conducts its business. It is reasonable to assume that a high rating country is more stable than a low rating country. This has a positive impact on a series of financial ratios, such as the tax rate, the interest rate, the country growth rate, and so on.
Okay, so we relate these two risks to the two risks that was mentioned in the previous slides. Now, if you remember in the previous slides na mentioned dito ang systematic risk and unsystematic risk. Okay, so when we speak of systematic risk, this is actually pertaining to the generic risk, which is applicable to all companies in the market. So, ang generic risk is also known as your systematic risk or pwede sad siya tawagon nga market risk because since this risk is generic, so applicable to everyone in the market. So that's why its other term is market risk. And in terms of portfolio analysis, we refer to this risk as non-diversifiable risk. Okay, and then specific risk is your unsystematic risk or diversifiable risk. Okay, so these risks are the same katong so balik ha, generic risk is your um systematic risk and this is your non-diversifiable risk as well and your market risk. Okay, sige, continue.
So, from a logical standpoint, the specific risk of the industry, beta, or it adjusts the country's risk. So, for example, if beta is 1.2 and the risk premium is 6.5%, the total risk of investment is equal to 1.2 times the risk of the country. So, in example, total risk is equal to beta times ERP is equal to 1.2 times 6.5, and that is 7.80. So, on the other hand, a modest industry risk, that is a beta of less than 1, has a reductive effect on total risk. For example, if the beta is 0.7 and the risk premium is 6.5%, the total risk of the investment is equal to 0.7 times the risk of the country. So, same as the previous example, so the answer is 5.55%. So a beta of less than 1 reduces the risk of the country. In other words, the low volatility of an industry or company partially compensates for country risk. So conversely, a beta of 1 is neutral with respect to country risk. So the ERP can be calculated in various ways, the complexity being proportional to the number of variables. Multiple methods can be used to determine the ERP, specifically the historical averages method, the modified historical averages method, and the implied method. So first is the historical averages method. So according to this, the ERP is equal to the spread between the return on market and the risk-free rate. So this is the formula. ERP is equal to R sub M minus R.
So when we speak of spread, Mon, what does it actually mean? The spread of meaning difference.
Ah, yes,
Ang
yes.
spread is difference. Okay.
The difference between So therefore, the ERP is equal to the difference between the return on a high volatility investment and the return on a low volatility investment. To avoid short-term effects which could distort results, the ERP is calculated based on a historical series relating to a reasonable number of years rather than just 1 year. Countries that have reliable statistics determine the ERP over a period of 50 years or more using arithmetic or geometric means. So the second is the modified historical averages method. It consists in making an adjustment to a base premium for mature equity markets. In practice, assuming the minimum possible risk for a stable country, a default spread is added that takes into account the greater risk of a less stable country. And the formula is ERP is equal to mature equity market risk premium plus the default spread or the default difference. And the last one, for example, considering that the US ERP is 5.69%, if a country has a default spread of 2.50%, the country's ERP is calculated as follows. So just add 5.69 and 2.50, we get the ERP of 8.19%. So the third one is the implied method, and the implied method is not based on historical series, but rather on an analytical model, according to which the stock value is equal to the ratio between the expected dividends in the next period and the difference between the required return on equity and the expected growth rate. So the formula in practice is V is equal to ED over the required return on equity RROE minus the expected growth rate G. So moreover, when we solve for the RROE, it is used as a arithmetic ED over V minus G. The calculation methods given here are for mere information purposes. Valuers are not required to independently calculate the risk premium, as there are various sources that can be relied. However, valuers must carefully consider which country they should refer to. So lastly, for the overview of the CAPM, so this is the value, this is the formula for CAPM. So to review, risk-free component and the risk component R plus beta times ERP. Minimum return, risk-free rate, and the beta and the ERP. I
Okay,
guess
now,
that's
so among the three methods that were discussed by Mon in computing for the ERP, for examination purposes, what we will use is only the first one. So that the historical averages method for examination purposes. So if the ERP or the risk premium is not given in the problem, so you can compute it by deducting the risk-free rate from the risk of the market. So manang RM, so this is the risk of the market minus R. R there refers to the risk-free rate. So um, risk market risk minus the risk-free rate, you will get your risk premium. Okay, so that because also in practice, this is the most widely used nga method in computing for the ERP. And then go back to the CAPM nga. Okay, so for the CAPM nga formula, so that is risk-free rate, are there risk-free rate, this is based on sovereign bonds, or when we say sovereign bonds, we are referring to government bonds. And why is that? I have mentioned it a while ago, because the government bonds have no risk at all, because the government is expected to really pay its obligations. So dili sila mutakas nimo. So there is no risk of default. So that's why sovereign bonds or government bonds are treated as risk free. So therefore the rates are risk free rates. And then beta, beta is your company risk specific to you, and then times the country risk, which is your ERP. This is again based on the historical averages method nga market risk minus the risk-free rate. And now, remind us gani mon, why do we need to know CAPM? Because this is relevant to in relation to business valuation. Asa gani na nato makit-an si CAPM sa ato ang income-based approach nga gihisgutan? Okay, so remember,
in the cost of
okay,
equity,
cost of
yes,
equity.
yes,
Okay, so remember, 'di ba, for income-based approach, we look at two valuations, the asset side and the equity side.
yes.
Now, under the equity side valuation, 'di ba, you have there free cash flows to equity over 1 plus CAPM. So, mo nang naghisgot ta og CAPM. Kay para if in case we are asked to compute the value of the firm using the equity side valuation, but then we don't have CAPM yet, kay apil man siya sa denominator, di ba? 1 plus CAPM. So, that's why we need to know how to compute for CAPM if not yet given sa ato ang problem. Okay? So, you need to know the formula for CAPM. Okay, let's proceed.
Thank you, Miss.
So along with the cost of equity, the cost of debt is also an important part in computing the company's weighted average cost of capital. So that will be discussed in detail by the next reporter. So you may be asking, why do companies calculate the cost of debt? The purpose is to find out how much of a burden these debts affect the business and if it is safe to take on any more debt. So cost of debt is also called after-tax cost of debt, is the cost that a company must incur to remunerate lenders, or basically the effective interest that a company pays to its creditors on its current liabilities. Next slide, please. So there are three variables that influence the cost of debt. We have the risk-free rate, or R, the spread, and the tax rate. Risk-free rate, again, is the basis of the cost of debt, or simply the interest an investor would expect from a risk-free investment over a period of time. The spread is the difference of yields calculated based on the risk of default of the target company. So typically, a higher risk means having a higher spread. And lastly, the tax rate, since interest expenses are tax deductible for the firm. Now, to compute the cost of debt, we have the formula. Cost of debt equals pre-tax cost of debt times 1 minus t. The pre-tax cost of debt is the sum of the risk-free rate and the spread. Thus, the formula K sub t equals R spread. So this must be stated net of the statutory tax rate, since again, interest expenses are tax deductible for the company. Next slide, please. Now, the easiest way to calculate risk of default is to refer to the company's credit rating. So currently, the widely used rating styles used to indicate credit ratings are from the prominent credit agencies, Moody's Investor Services, Standard and Poor's, Fitch Group, and DBRS. So as shown in the table, the highest tier or grade, AAA, represents an extremely strong commitment to meet financial obligations, whereas the lowest grade, D, would be an indicator that financial obligations in default. For companies with rating, lenders apply a higher spread to compensate for risk, whereas for companies where uh, higher rating not necessarily required. So the spread associated with the risks would depend on factors such as of the lender, characteristics of their credit history, and guarantees provided. Next slide. So what if a company's rating is an R or not rated? We have various alternative methods which may be used based on the following information. So first, a company's credit history for the last few years. The time horizon would depend on the average duration of loans. So let's say for companies that use short-term debt, it could be based on 2 to 3 years of data, while for long-term, they can refer to average loan durations. Next, we have debt composition and cost, since there are different rates that would apply to short-term and long-term loans respectively. So short-term debt would be generally more expensive than long-term debt. Next, we have ROD, or the average return on debt of the last few years. So you can compare the ROD of a company from different periods or compare to companies within the same industry. So ROD is a good approximation of the average interest rate of the target company. It measures the interest rate and is calculated annually, which is equal to the ratio of interest expenses to average debt. Thus, the formula ROD equals interest expenses over average debt. And lastly, we can use the financial ratios of the target company. Multiple ratios may be used to identify a firm's summary rating.
So next we have the weighted average cost of capital or the WACC. This is the calculation of a firm's cost of capital in which each category of capital, debt, and equity is proportionately weighed. As mentioned earlier, according to the asset side approach, the discount rate is composed of both the cost of equity and the cost of debt. However, the weight of equity and debt may not be the same, and therefore their costs must be weighed based on their respective amounts. Next slide. So the weighted average cost of capital is calculated as follows. It's the cost of equity times its proportionate weight plus the cost of debt times 1 minus the tax rate times its proportionate weight. The cost of equity is normally calculated using the CAPM, and the cost of debt is the risk-free rate plus the spread. Next slide. So to have a better understanding of the WACC, let us go through the problem found in the PDF. So here we have the problem. Let us assume that a French company engaged in the steel business has equity and debt of 400 euros and 600 euros respectively. Furthermore, there's a risk-free rate of 2.2%, a spread of 1.8%, a tax rate of 25%, and the sector's average debt over equity of 1.4. It is also given that the European beta of the steel industry is 1.46 and the French ERP is 6.40%. So as mentioned earlier, first we'll find the cost of equity using the CAPM. It was mentioned earlier that first we take the beta of the industry, unlever it, and lever it again with the consideration of the debt over equity of the target company. So first we unlever the beta using the formula as given. So we have the levered beta of the industry, which is 1.46 divided by 1 plus 1 minus the tax rate of 25% times the industry average debt over equity of 1.4 to get an unlevered beta of 0.71. Next, we levered the beta considering the debt over equity of the target company, which is the 600 euros divided by the 400 euros to get 1.5. So it is the unlevered beta, which is 0.71 times 1 times 1 plus 1 minus the tax rate of 25% times the debt over equity of the target company, which was earlier said to be 1.5, to get a levered beta of 1.51. With this information, we can now solve for the cost of equity using the CAPM, which is the risk-free rate of 2.2 plus the beta of 1.51 times the ERP of 6.40% to get a cost of equity of 11.86%. Next slide. Next, we solve for the cost of debt, which is simply the risk-free rate plus the spread, which is 2.2% plus 1.8 to get a cost of debt of 4%. Now that we know the cost of equity and the cost of debt, we can now solve for its respective weight, which is simply its respective amount divided by the sum. So for the cost of equity, its weight is 400 divided by 1,000 for 0.4. And for debt, it is 600 divided by 1,000 for 0.6. With the given, now that we solve for all of the components, we can now solve for the WACC, which is the cost of equity times its weight plus the cost of debt times 1 minus the tax times its proportionate weight. So that is 11.86 times 0.4 plus 4% times 1 minus the tax rate of 25% times its proportionate weight of 0.6 to get a WACC of 5.83%. Now,
Okay, so in simple terms, the WACC is, balik ka daw to ang formula. So, WACC is the cost of equity times the weight of equity. So kanang E over D plus E, that is actually the weight of equity. When we say weight of equity, meaning pila ka percentage ang equity in relation to its total capital structure. So like in the problem given, I think that was 40% si equity and then 60% si debt. So WACC is equal to cost of equity times weight of equity plus after tax cost of debt times weight of debt. So for cost of equity, since we already know how to compute cost of equity using CAPM, so I think okay na taan na. And then times weight of equity. So unsaon gyud na pag-compute si weight of equity? Tan-awat ang both equity and debt. Okay, so i-add nimo ang equity and debt and then i-compute nimo pila ka porsyento si equity sa total. Okay, so that is the weight of equity. And then plus the after tax cost of debt. Why is it after tax? So kanang 1 minus T, that is your tax retention rate, diba? So what remains after deducting tax? So therefore your cost of debt, cost of debt, no, kanang dapat siya after tax. Dili pwede pre-tax, dili pwede before tax, dapat after tax. That is why we have there 1 minus T. So whatever is the cost of debt, you have to deduct tax from it. So we call it the after-tax cost of debt and then multiply it with the weight of debt. Pila ka porsyento sa ato ang capital structure ang debt or utang. Okay, so next slide. So that's why here we have to compute first the cost of equity using CAPM and then multiply it with the weight of the equity portion. And based on the given here, the equity is 400 while debt is 600. So therefore, equity comprises 40% of the entire capital structure. So mo to siyang multiply na siya og 0.4. Sige, next slide. Okay, so equity here is 0.4 or 40%. So that is why the CAPM, which is your cost of equity, is multiplied by 40%. So 11.86% times 0.4 or pwede sad 11.86% times 40%. And then plus your after-tax cost of debt. So you deduct tax from the original pre-tax cost of debt, which is 4%, and then multiply it to the weight of the debt, which is 60% or 0.6. So therefore, you can get your WACC 5.83%. Now, Maxine, asa ganin nato gamiton si WACC sa atong income-based approach?
Cost of cost of equity.
Si WACC, asa man na nato gamiton si WACC sa ato ang income-based approach?
Sa asset side approach.
Correct. So sa asset side valuation, right? So for asset side valuation, you have there, the formula is free cash flows over 1 plus WACC. WACC being our discount rate used under the asset side valuation. Now, if you notice, nganong WACC man sa asset side and CAPM sa equity side. Remember that CAPM only measures the cost of equity, right? Equity alone. So we don't take into account the debts because CAPM are only for cost of equity. That's why maura na siya ato ang gamiton for the equity side valuation. However, for the asset side valuation, we have to look into the equity as well as the debt. That's why for asset side valuation, we are using unlevered amounts, right? Unlevered meaning wala na to gideduct ang equity ang debt. So unlevered meaning wala na to gideduct ang debt. So that is why the discount rate to be used under the asset side valuation is not CAPM but rather WACC because in WACC we both consider equity and debt. Diba? So WACC na atay cost of equity then plus cost of debt. Right? Okay, so WACC is for asset side valuation while CAPM is for equity side valuation under the income-based approach. But overall, when we say income-based approach, we are looking at the discounted cash flow model. So, kung baga, ang discounted cash flow model, mo na siya ang ato ang generic term. General siya kaayo, discounted. Gidiscount na to ang future cash flows into its present value using a specific discount rate. Now, the DCF, if imo siyang i-branch out into two, pwede siya asset side valuation, pwede sad siya equity side valuation, right? And what's the difference between the two? For equity side valuation, we are using levered amounts, so therefore gideduct na to ang debts. So that is why for equity side valuation, the numerator shows free cash flows to equity. Wala gideduct na tanan ang debts. But for asset side, ang ato numerator is free cash flows before deducting our debts. And then also remember the difference of the discount rates used. If asset side, WAC ang gamiton. For equity side, CAPM ang gamiton. So, ang kani siyang duha ka valuation, asset side ug equity side, these are all coming from the generic discounted cash flow model, which is your expected cash flows, diba? Future cash flows over a specific discount rate. Okay, so in general, again in summary, so for income-based approach, what we are looking at is the discounted cash flow model. Okay. Sige, so continue.
Hello. So we have already discussed about the cost of capital, the cost of equity, the beta, the discounted cash flow, and so on. And now it all comes to an end. This is a fundamental point when we do valuation. If you have a great products, those products may not be great for the next years to come. If you have a high growth company, it can't be a high growth company forever. So in this report, I'm going to discuss about closure in valuation, how we bring things together in the end. So just like in a relationship, when couples pass the honeymoon stage, or let's say they got plateaued, so couples are not happy anymore, they decide about to end the relationship or continue. So in business, we have the same. It's the same. We have two choices. At some point in time, we can assume that the business will end, and then we liquidate it and sell it for what it's worth. And the other is we can assume that the business will not end. It will continue beyond the point of time, going concern, or terminal value. Terminal value is the value of an asset, business, or project beyond the forecasted period, when future cash flow can be estimated. Terminal value assumes a business will grow at a set growth rate forever after the forecasted period. Terminal value often comprises a large percentage of the total assessed value. Since it comprises a large percentage of the total assessed value, it creates more mischief in valuation than any other input. So in this report, we will try to put some rules in place to keep that number from running away from you. So keep them in check. So in the next slide, so I've talked about terminal value as a closure in valuation. Why? Because it's the last piece in the puzzle. You can't estimate cash flow forever, right? The value of an asset is the present value of its expected cash flow over time. But remember this, what if you have an asset that can potentially last forever? Just like publicly traded companies. Since you cannot estimate cash flows forever at some point in time, you gotta stop, right? But you can't give up on cash flows either, diba? As humans, we are designed greedy, kisa mang dili ganahan di na makadawat kwarta. Murag wala, diba? So what we can do is to estimate terminal value. And how do we estimate it? There are three methods. One is liquidation value. So after 10 or 15, let's just say 15 years, you decided to shut down the business and sell it. Sell off its assets. That's liquidation value. This method is practically applied to private businesses. And the next alternative is the multiple approach. It is the easiest approach, but make the valuation a relative valuation. And the last alternative is perpetual growth model. It is also called as going concern value. the most sound method but requires a lot of judgment with regards to the stable growth rate of the firm and its excess return, if any, during the period. So in other words, you assume that the business will continue forever and earns cash at constant rate. It's like, diba, in high school, in your mathematics, we were asked to calculate a problem regarding infinite series, diba? So we solve it using a formula capturing the sum of an infinite series. So in growth model, that's pretty much what happened here. So among the three, scholars argued that only two are legitimate, the liquidation value and the growth model. Because they argue na ang multiple approach daw is mainly doing relative valuation, not using discounting method, di ba? In the previous discussion or the previous report, they're using, there were no mention of discounted cash flows, free cash flows, something like that. But however, MA or multiple approach is used mostly by investment bankers. So later on, we will discuss as to why it requires a lot of judgment. So in the next slide, we can see here the formula for a terminal value. Terminal value is equal to your cash flow divided by your difference of the I and G. So cash flow, T plus X, I'm sorry, that's plus. I'm wrong, typo right there. Plus na siya guys plus. Your cash flow, T plus X, is your expected cash flow beyond explicit forecast period explicit forecasted period. So let's say the company forecasted its earnings up to 10 years lang, 10 years or 15 years. So the year or years after that, that is now your terminal value. And the next variable is I, discount rate or the cost of capital or cost of equity. And your G is your expected growth rate. This constant growth rate is called a stable growth rate and cannot be higher than the growth rate of the economy in which your firm operates. So in the next slides, we will discuss thoroughly these variables, especially the growth rate. So the first variable is the cash flow T plus X. So in here, we have two examples of expected cash flows, Series 1 and Series 2. As you can see here, Series 1 has, let's say, linear increase, like 100 to 110 to 120, 130, di ba? Plus 10, plus 10, plus 10 lang. While your Series 2 has varied increase, like plus 14, plus 15 na sad. However, it has higher increase in the end. So in Series 1, again, 100 to 140. While in Series 2, it's 100 to 230. So without solving, you can already see na what series is inconsistent. So we will, after that, we will solve its consistency. How we're going to do that? By using standard deviation. Through solving, we can see that Series 1 here has a lower standard deviation, means modest dispersion around the mean. While your Series 2 has higher deviation, means greater dispersion. So, mas consistent si Series 1. So, murag, it's like murag relasyon na po. So, it's like relationship. Lower standard deviation, murag consistent, while ang higher standard murag usahay consistent, usahay bakakon, ano. So in Series 1, since there's a lower standard deviation, TV can be calculated using the cash flow of the last year. So dali lang. Okay, we're sure man consistent. However, in Series 2, TV, the terminal value may not be properly represent its stable value. However, don't worry, there's a remedy to that, because in in real life scenarios naman, dili man jud consistent because the market is volatile and so on, like that. However, there are remedies by using arithmetic average. So by through arithmetic average, we can solve by 100 plus 140 plus 190 plus 230 divided by 4. So ang answer na is, if you calculate it, 165. So the other one is weighted average. You assign numbers or weights to each of the cash flows and the way you assign it is, for the plus one, the t plus one, you assign a higher value. So you assign times 4. So 100 times 4 plus 140 times 3 plus 190 times 2 plus 230 times 1. Then you divide it by the overall weight. So 4 plus 3 plus 2 plus 1. So that if you calculate it, the answer would be 143. Now, as an analyst, you can now choose between the ranges from 143 to 165. 143 from the arithmetic mean, 165 from the weighted average, to decide what will be your terminal value. So in the next slide, the discount rate or your I. You can see here, there are two different formulas for the asset side approach and the equity side approach. For the asset side approach, it is your free cash flow over WACC minus G, while your equity is free cash flow to equity all over CAPM minus G. So the only difference is that the FCF, or the free cash flow, is unlevered, while your FCFE is levered. So that's what Ms. had mentioned. And your asset side, that the free cash flow is including your debt, while your equity side, the free cash flow to equity is debt is deducted. Now, on the next slide, we are now on the growth rate. I believe there are a lot of formulas for growth rate, and this is one of those. But don't worry, in problems like this, the growth rate is mostly likely given. I hope so. But this is just to show you the formula. No, because in the next slide we will discuss now how hard is growth rate. Growth rate is mostly reliable to your judgment as an analyst, not really the formula. So in the next slide, the value of your growth rate will most likely put you in trouble. As to why? Because it constitutes a large percentage of change in your valuation. Next slide, please. So that is why it is important to keep this number in check. And we will establish rules that will help us put this number in place. So first, let's put a cap. Make sure we don't exceed the cap. Remember, we assume going concern here. We assume that the company's cash flow will grow at a constant rate forever, di ba? So, and that growth rate should not, because of that, growth rate should not exceed the growth rate of the economy. Alangan for example, galisod ang nasod pero imong company is booming. Kuya, umusad na. So we can actually use an alternative here, like the risk-free rate, as discussed earlier. The risk-free rate, so again, what is risk-free rate? Yan these are rates na katong treasury bonds, siguro time deposit. Second, we should decide when will our company will have a stable growth rate. So as firms become larger, it becomes much more difficult to maintain high growth rate. So you should ask questions. No, does the company have strong barriers to entry? If so, then high growth rate. Also, don't wait too long, ha? Okay, most companies they wait too long to project its stable growth rate. Let's say 20 to 30 years. But for example, look at Facebook. Facebook, sikat na Facebook like not 20 years from now, di ba? Brag, 2006 pa ang Facebook. So, karon sikat na kayo like pag 2011, natin Facebook, almost every person. And third, it's excess returns. This is the return in capital that company will earn in perpetuity. So compare your return in capital and cost of capital in stable growth. And last piece, when you make a company stable growth company, give it a characteristic of a stable growth company. For instance, if you have a beta of 2 and high cost of capital during a high growth phase, it's okay. But when your company becomes a stable growth company, I would expect to see that the beta move towards 1, maybe using more debt in the capital with a lower cost of capital, because your company cannot change in terms of growth with everything else remaining equal. So again, we remember that beta is the risk, is like identifying the risk. More beta mean more risk. So on, so on. So terminal value is like mura gitarot imong business bitaw ilang gitagna. So as you can see here, G is really the most important variable for me, na ba? So these terminal value are mostly practiced by the investment bankers. So I believe investment bankers are na whole like mga smart ass people at a whole another level, because you need to have a sound judgment here. So, because being an analyst is like having superpowers who can see the future, being visionary. Okay, you just don't look. They look every details. So because you don't just look at the pixel of the picture, you need to look to see the whole picture, even including the frame. Because, for instance, if ako'y analyst, I am tasked to analyze, sample, CD market. CD katong sa una pa bitaw na play of music or a movie. I need to see what are the developing technologies around, their barriers to entry, their cost of capital, everything like that. Because what if the CD market then suddenly after 5 years internet came, diba? So I need to look at that, because in identifying growth rate, I will adjust the growth rate. So in the next slide here, there's an example that is it will show you why growth rate is very, very, very important. Fine. For example, let us assume that the following values: free cash flow in the 5th year is $100. Your WACC is 7% and your G is 3%. The terminal value without the growth rate is as follows. So 100, again, the formula for terminal value is cash flow T plus X all over the difference of your I and G. Here, $100 over 7% is 1,428. Now, if we include the growth rate, that would be 100 divided by 7 minus 3 or 4. The answer would be $2,500. So we can observe that the TV increased 75% due to the growth rate, and we should remember that the terminal value is like the value of the company in the foreseeable future, diba? Gitagna. So ang terminal value is very much more estimated lang, diba? Estimated lang, walay nakaibaw jud mismo sa exact value. Since dako siya increase, dako sa risk bound to mistakes. Diba? That's why we put rules in place, the 4 rules that I've mentioned in the last slide. Diba? So to summarize, TV means capturing the book end value of the company beyond explicit forecasted period. So we use TV again to to identify the value of your company beyond the explicit forecasted period. So we need always to, and we put 4 rules to keep that in place. So that's it.
So I'm here to talk about the dividend discount model. And the dividend discount model is a model that it's different from the discounted cash flow model, but it's similar. So it's a variant where the DDM, or the dividend discount model, calculates the value based on the ability of to pay shareholders dividends. So that means instead of expected cash flows, it considers the expected dividend per share. Next slide. Now, this formula for the dividend discount model, and as you can see, the expected dividend per share is considered instead of the expected cash flows. Furthermore, it is a summation of expected dividend per share divided by the capital asset pricing model plus 1 raised to the power of the number of years. This formula creates the value per share, and it's to be multiplied by the total number of shares to get the value of the firm. In getting the expected dividend per share, one must get the earnings per share and multiply it by either the actual payout ratio or the prospective payout ratio. Next slide. A variant of the model that discounts the expected dividend per share according to the perpetuity formula. The perpetuity formula refers to a stream of cash flow which continues indefinitely. And in this equation, it is seen with the addition of the growth rate, which is deducted from the capital asset pricing model. Now, the growth rate is calculated by multiplying the retention ratio by the return of equity. And the retention ratio can be computed by getting the percentage of net income that is retained to grow the business. And this is often the opposite of the payout ratio, the earnings, which is used as the earnings paid as dividends. So that means it's whatever that was paid out as dividends not is not the percentage of net income to grow used to grow the business. Next slide. Now, now the DDM and the DCF has a few differences, being a variant. So the DDM calculates by considering the investors' perspectives on their expectations to maximize invested capital. So that means there's a trade-off between maximizing short-term value dividend by dividends payouts, thereby lessening growth rate. And second, the DDM is based on the forecast of dividend payouts, and this amount is potentially distributed. This is the potentially distributable dividends based on the cash flows available. Thank you.
Okay, can we go back to the previous slide? I just have to add something. Okay, so katong DDM, katong comparison. Okay, so as mentioned by Robin, no, a DDM is merely a variant of the DCF. So if you remember the discussion on the valuation standards at the onset of the report, at the start of the report, diba, the group discussed the Philippine valuation standards with regard to the income-based approach. And there it was mentioned that we have actually two models under the income-based approach. So we have the katong income capitalization and then the discounted cash flow and or the DDM, right? So but most of the time it is the DCF that is used instead of the DDM because here DDM, diba, from the word itself, dividend, it is using dividends instead of your future cash flows. So like dividends here in number 2, it is mentioned that dividend payouts are uncertain. And why is this so? So even though this company, for example, is a stock corporation which is bound to pay dividends to its stockholders eventually, but the law doesn't ang ato ang especially the Philippine law, no, we do not actually oblige the stock corporations to pay out the dividends every year. So, if you are a stockholder of a certain stock corporation, you cannot demand dividends from the corporation every year. So, this is really based on the discretion of the board of directors of the of the stock corporation, whether or not they will pay out dividends for a particular year. So they are actually allowed to retain all the earnings for the company to use sa ilahang mga projects and so on. So dili sila obliged to pay out dividends every year. They will only be obliged to pay out dividends every year if the total retained earnings exceed 100% of their paid up capital. 'Di ba? You have their sa ito ang income taxation, you have the improperly accumulated earnings tax, right? So if a stock corporation fails to pay out dividends in such a way that the retained earnings have already exceeded 100% of their paid up capital, then they will be penalized through the imposition of the improperly accumulated earnings tax. However, if the retained earnings doesn't exceed more than 100% of the paid up capital, because wala sila nagbayad og dividends, pwede ra gihapon. They are allowed to do so. They are allowed to retain a portion of their income, even 100% of the income, as long as the total retained earnings does not exceed 100% of the paid up capital. So we can say that if you use DDM, again, we cannot really forecast, or we cannot read the minds of the board of directors nung this year kanang mo declare sila dividends, and then next year mo declare gihapon, and then on the third year dili na sila mo declare, so we cannot read their minds. So that's why DDM is um not not as popular as the DCF model. So in our examinations, what we will use is the DCF. And as mentioned by Daniel also in passing, no, kanang when he discussed growth rate, there was a very complicated formula in computing for growth rate. So ingon siya nga, I hope ihatag ra sa exam. So yes, for growth rate, you don't need to compute for growth rate. So all you need to understand is the basic lang here. So all you need to remember is the formula for the asset side approach, for the equity side approach, and the formula for CAPM and for WAC, but katurang mga basic variables dito. So if you think based on your judgment that this type of formula is very much complicated nga, because we treat ourselves here as mga you are treated as beginners pa man, so you are not expected to learn all the complex formulas. So just the basic, because ang katong inyong mga complicated formulas, you will get to learn them when you are in the actual practice na. So if your future job entails the preparation or the computation of these very complicated amounts, then diha na ninyo ma-learn ang actual jud application of those complicated formulas. But as students, ang ato ang basic competence on the subject will only require us to remember katorang mga basic formulas. Okay? So, a round of applause for the group. You really understood the topic and you were able to discuss it very efficiently and effectively to your classmates. Thank you so much. And then, just like what you had with market-based approach, I have here a short quiz on income-based approach, but I am giving you until 12 p.m. of Sunday to answer it. Only 4 questions and then good for 15 minutes. Just answer it when you have the time. And the questions are purely based on what we have discussed today. Right now, for the asset-based approach group, wala pa ko nakadawat sa inyong PowerPoint presentation. So please do email it within the day. Okay, so I could also grade you. Okay, kamo na lang ang wala pa nakasubmit sa email. right? And then the links for the recordings as well as a copy of their PowerPoint presentations will also be uploaded in Canvas during the weekend. Do you have any questions so far?
Na ako'y question, ma'am.
Yes, Daniel.
So in practice, ma'am ba, if for instance na ay mga short-term circumstance, for example, COVID, I mean,
Mhm.
siguro short-term ang COVID, i-adjust na ang values, ma'am?
Yes, for example, the effects of the COVID-19 pandemic is not only um felt in just a year, no? So there are actually mga speculations nga the effects of the COVID-19 pandemic would really extend to like 3 to 5 years or even more than 5 years. So therefore, in using your discounted cash flow model, diba, you are expected to forecast your future cash flows, right? So let's say cash flow for the next year and then 2 years, 3 years and so on until 'di ba nag-discuss ka og terminal value. So until such time nga dili na nimo ma-forecast ang cash flows for every year. So that's why because for example at a specific point in time sa imong time horizon you will now experience a stable growth of your company after, for example, after na the effects of the COVID-19. So you have to adjust also your cash flows, especially if your business is engaged in an industry where the effects of COVID-19 pandemic is really prevalent. Like for example, in travel, if your business is into the travel industry, diba, because of the restrictions of travel, so mas affected ang imong business as compared to let's say healthcare industry nga. Ang effects of COVID-19 pandemic is not even detrimental but advantageous on your part. But there are also industries nga neutral. So for example, you are into the provision of one. Can you mute for a while? Okay, so for example, you are into kanang the provision of basic services or basic mon mon na distract ko. Okay. So for example, ikaw imong business is into the rice production. Okay, so regardless of whether there is COVID-19 pandemic, I think everyone is still consuming the same amount of rice, no? So, kay basic need man na nato. So, probably ang COVID-19 pandemic is not ang effects of COVID-19 pandemic is not really felt sa imong company. So, you have to you can actually just rely on your previous um estimate of your cash flows as compared to other industries nga mas na affected jud sa COVID-19 pandemic. Okay. So ana ra imong i-analyze ang imong business in relation to which industry your business is engaged in.
Thank you, ma'am.
Okay, so I think we had a very thorough discussion on the income-based approach. Again, thank you so much for the group. You did a very good job. And I hope nga ma-maintain na to ato ang momentum until sa ato ang last approach, which is asset-based approach. Again, I'm requesting the members of the asset-based approach to please send your PowerPoint presentation within the day through my email. And I think everyone is here. No one is absent, man. Thank you also for the non-reporting students, no, for attending the class, and I'm sure nga you have also learned something, and I hope nga you made your notes pod because there are some topics or yeah there are some topics there in the handout nga might be very complicated but were simplified by your reporters. I hope nagbuhat mo dirag mga notes on your own para come the exam time dili na mo need mo tan-aw sa katong wordy kaayo nga presentation sa PDF but sa inyo na lang notes. Okay, and then anyway I have recorded this discussion man so you can refer to the recording when you feel the need to do so. Okay, thank you so much for attending again. Please make sure to answer your short quiz sa income-based approach which will be available until 12 p.m. Sunday. Right? Sige, so see you all again on Monday and good morning.
Good
Thank
morning,
you.
Miss. Thank
Hello, Miss.
you.
Thank you, Miss.
Miss.
Miss, until Sunday,